The concept of money is a fundamental element of modern civilization, yet its true nature is often a subject of complex economic discourse. At its core, money serves as a universally accepted medium of exchange. Before the advent of money, human societies relied on barter, a direct trade of goods and services. This system, however, had significant limitations. Primarily, the need for a double coincidence of wants, where two parties each hold an item the other desires. Money emerged as a solution to this inefficiency, providing an intermediary tool that separates the act of selling from the act of buying. Historically, various items have functioned as money, a form known as commodity money. These were objects with intrinsic value, such as salt, shells, beads, or precious metals like gold and silver. The value of these commodities was recognized independently of their role as a currency. For instance, gold could be used for ornamentation and salt for preserving food. The transition from commodity money to representative money marked a significant evolution. Representative money, such as a paper certificate, has no intrinsic value itself but represents a claim on a physical commodity, typically gold or silver, held in a vault. This system, known as the gold standard, allowed for easier transport and transaction of value without the physical burden of carrying heavy metals. Modern economies predominantly use what is known as fiat money. The term fiat is derived from Latin, meaning "let it be done." Fiat money is a currency that a government has declared to be legal tender, but it is not backed by a physical commodity. Its value comes from the trust and confidence that people have in the issuing authority, usually a central bank or government, and its acceptance for transactions within the economy. This trust is crucial. The stability of a country's government, its economic policies, and its ability to manage the money supply are all factors that underpin the value of its fiat currency. Unlike commodity money, the cost to produce a banknote or a digital unit is negligible compared to its face value. Economists generally describe three primary functions of money: a medium of exchange, a unit of account, and a store of value. As a medium of exchange, it facilitates transactions, making commerce more efficient than the barter system. As a unit of account, money provides a common measure of value. It allows us to price goods, services, and assets in a standardized way. For example, instead of expressing the price of a car in terms of thousands of loaves of bread, we use a monetary unit like dollars, euros, or yen. This common denominator simplifies economic calculations and comparisons, making it easier to understand relative values, record debts, and make financial plans. A consistent unit of account is essential for the functioning of complex markets and for maintaining clear financial records for businesses and individuals. The third function of money is to act as a store of value. This means that money should, in principle, retain its purchasing power over time. An individual can hold money today and expect to be able to spend it on goods and services in the future. This function allows for saving and investment. However, the effectiveness of money as a store of value can be affected by economic factors, most notably inflation. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. If the rate of inflation is high, the value of money held in savings diminishes over time, meaning it can buy fewer goods and services than before. Therefore, the stability of a currency's value is a key concern for economic policymakers. The scope of what constitutes money has also expanded significantly with technological advancements. Initially, money was purely physical coins and banknotes. The 20th century saw the rise of commercial bank money, which includes funds held in checking and savings accounts. These are digital entries in a bank's ledger but are widely accepted as a means of payment through tools like checks, debit cards, and electronic fund transfers. In most modern economies, the vast majority of the money supply exists not as physical currency but as these digital records within the banking system. This form of money is created through a process known as fractional reserve banking, where banks hold only a fraction of their deposit liabilities in actual cash reserves and lend out the remainder. In recent years, the digital revolution has introduced new concepts into the monetary landscape. Electronic payment systems have become ubiquitous, allowing for instantaneous transfers of funds across the globe. Furthermore, The emergence of digital currencies and cryptocurrencies presents another layer in the ongoing evolution of money. These are digital or virtual tokens that use cryptography for security. Unlike traditional bank money, so many of these particularly decentralized cryptocurrencies operate on a technology called blockchain, a distributed ledger that is not controlled by any single entity like a government or a bank. Their classification as money is a subject of ongoing debate among economists and regulators. Some view them primarily as speculative assets, while others see their potential to fulfill the traditional functions of money in new ways. The subject of money is therefore not static, but is constantly evolving. It is an abstract social construct, a system of trust and agreement that allows for the complex coordination of economic activity on a global scale. Its form has changed from physical objects with inherent worth to government-backed paper notes, and now to purely digital entries in vast, interconnected networks. The principles that govern it are central to the field of economics, influencing everything from individual household budgets to international trade and global financial stability. Understanding money is not merely about understanding currency. It is about understanding a fundamental system that underpins the structure and operation of societies around the world. The study of its history and functions provides insight into the economic mechanisms that shape human interaction and development.